I'll skip right to the good part. So without further ado, I'd like to introduce our founder and CEO, Don Wenner.
Turn it down just a little bit. Turn it down just a little bit. Oh, you can do it right here. There we go. Having to turn the volume down there a little bit. I heard you, saw you up front here. Welcome. So my name is Don Wenner, as Larry said. Before I get started with the presentation, I want to do a little poll of the room here. So if you're an existing DLP investor, if you could do me a favor and stand up. Sorry, Andy. So these are all of our current investors here. So they're the people you want to talk to tonight. Looks like they're pretty well spread out across your tables. They'll tell you their exact experiences and all about really how their experience has been with us. We have some investors who you're going to hear from tonight who've been with us for a long time. Hear more about their stories, why they invested with us, and how that experience has been. And then before I get started, I would like to just have one more group of people stand up, which is our team members. So DLP team members, please stand up. So round of applause for them, please. Awesome. So I get to do the fun job of the presentations, and they do the hard work all day. So thank them. I thank them very much. All right, so we'll get started here. So hopefully you all know a little bit about us today. And if not, that's okay. I'm going to give you an overview of what we do here. And before I get started, I want to talk a little bit about investing in general. And whether you're investing in real estate, investing in a private fund like us, any investment you're looking to make, I look at it, there's two things that are really important. Number one is the strategy. So what is the business plan? Does it make sense right now with where we are in the economy? And then two is the ability to execute on that business plan. So just because you're investing in a good strategy, if you don't know how to execute and actually generate results, doesn't always work out really well. So we're going to show you tonight why we're in two really great strategies and how we're able to execute as a manager. So what we do, the two strategies we invest in, first is direct lending backed by real estate. So direct lending to real estate investors. We lend money to people who buy real estate, renovate it and sell it, or buy real estate, renovate it, and rent it. And then we also buy real estate. So we're a real estate operator, mainly buying apartment communities, multifamily investing. So those are our two strategies, lending to other investors and buying real estate directly. I'm going to tell you a little bit about both of those strategies and how you can take part in them. Our ability to execute in those two strategies come down to DLP as a family company, or the fact that we're a vertically integrated operator. What that means is that everything I'm going to show you tonight, everything we talk about, we actually operate this strategy. We run all the family companies, all the businesses that support our ability to generate these kind of returns that you're going to see and execute on these strategies, from property management to construction management to lending to capital management to real estate sales. All the components of executing we do in-house, which you'll learn more about. We have over 300 team members here at DLP. About 20 or 30 of them are in the room here tonight with us. And we follow a system we call here at DLP the DLP Elite Acceleration and Execution System. And it's the way we set priorities, hire people, manage our meetings, solve problems, help us drive results throughout our companies. And we'll talk a little bit about that tonight as well. So why you should be interested in what I'm going to talk about tonight, other than the fact that we're going to serve you some great food, are the returns. So we have two different ways you can invest. First is as a fixed return investor, and you'll earn a 6 to a 9% fixed return on your money with monthly distributions. Or you can invest as a partner in our funds, and the funds vary a little bit, but they all generate over an 11% annual net return to investors. And we have a couple of different strategies that I'm going to show you here tonight. So those are the financial reasons or the returns that hopefully pique your interest and grab your attention to invest with us. The other reason you should be interested in investing is if one of these apply to you. So you have a family and you want to be able to provide security to your family now and in the future. You're in retirement and want consistent, stable income. You are planning for retirement and want consistent investment growth. You have concerns about the economy and you want to protect your money before the next market correction comes. Or 5, you like to have a good night's sleep. So hopefully at least one of these apply to each of you here tonight. And if it does, then you're going to be interested in what we talk about. All right, so our principles here at DLP, how we think about investing, although I started off with telling you how great our returns are and the kind of distributions that we pay out to investors, which we think are exciting and we think are really great returns, that's not our driving force in how we invest. We have a few rules here to how we think about investing. First and foremost is do not lose money ever. That's a really big deal. Do not lose money ever. And we've been managing money for over 12 years. We have 0 losses to investors ever, and that's a really big deal to us. Number 2 is consistent returns. We want our returns to be so consistent they're boring. As I know, Kurt, you told Larry the other day. We want our returns to be boring because they're so consistent. You can count on it. You know what you're going to earn month in and month out, quarter in and quarter out. And then third is we try to generate the highest return we can without taking risk of principal loss and without risking being able to generate very consistent returns. I know that sounds really good and that might sound too good to be true, but I'm going to show you and demonstrate how we've been able to do that. So what do we do here? How do we generate these returns? How do we mitigate risk? What we do is we invest in people and in real estate. And it's really important when I say we invest in people and real estate. That means DLP, and that means you as investors. That's what we're doing. We're investing in people who are other investors who are buying real estate, renovating it. We're investing in them, in their business, and in the underlying real estate. And here in the people at DLP, the 300 plus team members who are generating the results and operating, managing our investments every day. The results of what we do. Right now, we provide safe, affordable housing to more than 20,000 people right now. More than 20,000 people live in our apartments right now and homes. We support more than 200 entrepreneurs who are buying real estate, renovating it, improving it, building a rental portfolio. So we support them by providing them with capital, knowledge, training, and that in turn drives many local economies, provides many jobs, does a lot of good in many communities. We provide jobs to over 300 team members and support their families. And in turn, we generate very consistent, reliable income to you as investors. So that's what we do. If you could sum up everything I'm going to talk about, that's what we do. In picture format, which is a little bit easier to understand, this is what we do. So these are some of the apartment communities we own, some of the people we help, some of our team members at some of our recent parties. So everyday houses, everyday apartments, are what we're investing in. So a little bit about DLP. These are all the companies across the family of DLP companies. You're going to see, for some of you who've been here a little while, with us for a while, you're going to see a newer brand on the very top there, DLP Real Estate Capital. We just rebranded ourselves as DLP Real Estate Capital as our parent entity that oversees our family of companies, which consist of DLP Realty, which is our real estate brokerage, DLP Capital Partners, which is the investment management company. That's who you're here with tonight. Direct Lending Partners is our lending business, and Real Estate Management does the asset management, property management, construction management of all of our properties. And then we have a marketing company and a couple other businesses as well. These are the leaders who make things happen here at DLP. A few are with us tonight. Bob Peterson, Patrick O'Donnell, Barry DeGroot, 3 of our executives are here in the room tonight. You guys want to stand up? Well, Patrick's already working the mic over there. We got him working here tonight. So these are the executives who make things happen, and Barry and Bob are also partners here at DLP Capital Partners as well. And these are the rest of the executives who oversee our family of companies. So if this is your first time with us, I'll tell you a quick little bit about myself. And those of you who've been here a few times, I apologize. So I've been in real estate now for about 13 years. I've closed now just over 10,000 real estate transactions, including acquiring more than 10,000 homes and apartments. Over $1.2 billion in real estate transactions. I've been ranked in the Wall Street Journal as one of the top 15 real estate professionals in the U.S. each of the last 5 years. And I am the founder and CEO of all of our family of companies. And currently we own, along with our investors, over 9,200 homes and apartments. And then I have 2 little boys right there, Donnie and Alex. We actually live right over here in the neighborhood. And actually, their grandparents, my father and stepmother, are in the back of the room here. So feel free to get a chance to talk to them here tonight. And this is the first time ever our kids are staying not with their grandparents, and they're actually staying with Barry's son right now. So let's all cross our fingers that that's going well. And my wonderful wife, Carla, who's right up here. So a little bit about DLP. We have a purpose here at DLP that all of our companies get behind, which is Dream, Live, Prosper, which is what DLP stands for. Passionately creating prosperity through real estate. That's what we really focus on doing throughout our family of companies. These are the 8 core values that drive how we operate, how we hire people, how we evaluate people, how we behave each and every day, and what we demand from our team members and how they behave each and every day. And it's a big part of our culture and a big part of understanding who DLP is. I believe that great companies solve problems. I believe at the end of the day, you're going to have a hard press to find a really great company that doesn't solve problems. That's what great companies do. So this house, this property here, is actually a property that I bought. It's actually 5 apartments. And this home property was owned by a gentleman named Paul Horner. And Paul Horner is a really, really interesting story, and it's probably a story that a lot of you can relate to in some way or another. So I've known Paul now for 10 or 11 years, and Paul was a janitor his entire life, making whatever a janitor makes, $30,000 a year, $40,000 a year, probably at his peak when he retired. And his entire career, what he did was about every year or two, he went out and bought a piece of real estate. So he saved his money, and he built up a portfolio of about 50 apartments, a laundromat, a number of homes. And so Paul came to me about 10 years ago. He had heard us on the radio in Pennsylvania, which some of you heard us on the radio here. And he heard a commercial like this one here, like this one here, which hopefully I can play this audio. Give me one second. When we did this in Pennsylvania 2 weeks ago, the guy whose voice you're going to hear came to the dinner and did it live, so let me make sure this audio works. Let's see, volume's low. So, well, we had it for a second there. All right, we'll try this again a little bit. It was supposed to be on the audio through the whole place, and you heard it for a second, so I'm not sure what the problem was, but I'll try to play that later. But regardless, what he's saying is it's a 60-second commercial that we run on local radio where we talk about how we provide people with an immediate cash offer. Don't have to deal with showing your home, don't have to deal with commissions, don't have to deal with doing repairs. And that's actually how we've purchased over 1,200 homes. It's mainly been buying homes, people who just don't want to own them anymore. Maybe the home is dated or run down, or in this case, Paul's case, or some of our other investors, one of which you'll hear from tonight, Paul was concerned. He built up this portfolio of 50 plus properties worth over $5 million. He had no loans. And again, he did this on a janitor's salary. But he came to me worried. He was about 70 years old, and he was worried about his kids and his wife having to take over his real estate portfolio because they had no interest in owning real estate. So steadily over the past 10 years, I've purchased all of Paul's properties and now have owned every property that Paul owned, and then he turned around and invested that money back with us. So we facilitated him getting out of active real estate ownership and becoming an investor with us and receiving very consistent income that he can pass on to his family without worrying about them doing the everyday management. And this is how a lot of our first investors came from us, as well as how a lot of our first investments were done. When we started investing, it was to solve people's problems. It wasn't because we wanted to be an investor, it's because this was 2006, 2007, 2008, and people were suffering and in distressed situations, so we came in and would solve those problems. And that's how people started investing with us. They started saying, well, I don't know what to do with the money if I sell the property. And we said, well, we can help you with that. And what we started doing with Paul, and we've done with many of you here in this room, is we paid him a fixed return on his money. And he's been earning a fixed return now on his money for 10 plus years and has continued to add as we've bought each of these properties from him over the past 10 years. And that's how a lot of what we do came to be. All right, let me go. Oops. Sorry there. Yeah, I'm just trying to stop the audio there. All right, let me get this back on Zoom. Sorry, everybody. All right, so as I kind of just said with Paul, we've had 0 months ever missing our returns to our investors. So not only have we had 0 losses, we've never missed a fixed return to any of our fixed note holders. We've never missed a targeted return to any of our equity investors for any period ever. And we've exceeded our return targets always, generating double-digit returns to all of our equity investors in all 6 of our funds. Part of the reason we've been so consistent in our distributions and our growth of our investors' capital is the consistency in how we run DLP. So at DLP, we've been one of the 5,000 fastest growing companies in America for 6 straight years. Last year, when we made this list for the 5th straight year, we were the 10th fastest growing company in America in all industries that had made this list 5 times or more. Because it's very hard. They measure your growth over 3 years. So you have to keep consistently growing to stay on that list. And we've grown very, very consistently year over year. We've averaged a 350% growth over every 3-year period of time for 13 years now. So when people say, wow, it looks like you guys are growing so fast, we are, but it's the same way we've been growing for 13 years, very, very consistently. Here's what that translates into today. So in the past year, we've sold over 1,250 properties through DLP Realty. We have over 520 active investors with us here, 30 or 40 of which are in the room tonight. We have over 300 loans to investors who we lend money to in our lending strategies I'm going to talk about next. Again, we own over 9,000 apartments and homes, over $600 million in assets. We do over $100 million in revenue. We again provide housing to over 20,000 people. We support more than 200 entrepreneurs, and we have over 300 team members. And again, most importantly, no losses to investors, no periods where we've missed our returns. But we're still growing. So you might be thinking, that's great. Why am I here tonight? Why am I inviting you out here? Because we're still growing. We're still going to continue that march forward and continue our growth. Here's our goals by 2025. To have over $1 billion in capital under management, own over $1 billion in real estate, and have over $1 billion in loans to other real estate investors. So we're still growing steadily, and this will just continue the march we've been on for the last 13 years. A little bit about DLP Capital Partners. I have 2 partners who are in the room here tonight, Bob Peterson, our CFO, and Barry DeGroot, our Chief Legal Counsel. We are approved with many of the major brokerage custodial platforms. So that means you can invest with us directly, but also through Charles Schwab or other major brokerage custodial platforms. We are located in Bethlehem, Pennsylvania, is where our company's headquartered. We're actually moving to a new headquarters a couple miles away next month. And then right across the street, where some of you just joined us, is where our Southeast headquarters is. And then we have 3 other offices throughout Florida and Pennsylvania. And then we have employees out at our communities that we own all throughout the South. Over 500 investors, many of which are in multiple funds with us. Here's where we do business. So everywhere in green is where we're set up to do business legally. If you see a number, even if you can't read the number, if you see a number in there, that's a state that we actively have business, that we're doing business in. So the black are states where we're lending money to investors. The white is where we own properties. So these little houses that you probably can't see them exactly, but you can kind of get a feel for it, and they're in the brochures as well, are all the places we own apartment communities. So you'll see we're in Pennsylvania and New Jersey, where we're headquartered, and then heavily throughout the Southeast. One of the main reasons, in addition to great returns and consistency, people invest with us, and I've heard it from a few of you already tonight, is transparency. That we don't operate in a black box type environment here. We don't know what you're invested in. You don't know what we're doing. We're very transparent with what we're doing. We have a website called DLP Crowd that you have access as a prospective investor to see all of our past financials, balance sheets, income statements, asset tapes, third-party audits on any fund, so you can do research and due diligence on us. As an existing investor, you have access to all of that, plus is where you can see all of your distributions, all of your reporting, everything related to your account. And then we do events like this all the time where we're sharing and telling what's going on. We did a happy hour before the dinner for our existing investors where we shared some insight to what's going on with the real estate market and what's going on here at DLP. So we try to always be communicating, sharing, being very open about where we're at in the real estate market, how we're going to handle that, which we'll talk a little bit about yet tonight. So before I continue and talk about our investment strategies, which I'm going to do next, I'm going to get an opportunity to take a little break and welcome a good friend and an investor of ours for quite a while here, Bud, who's going to tell you a little bit about his experience in real estate and his experience with us. So round of applause for Bud, please.
Thank you.
All right, so actually I'll pass it over. So I'm going to go ahead, Bud, and ask you first of all, how long have you been invested with DLP?
We've been with DLP for, this is our 6th year that we're in with them.
So before investing with DLP, tell us a little bit about your background in investing.
We had 30 years in real estate. My wife's a realtor. I was a school teacher. I started investing in real estate only to provide myself with a better pension plan that I could that I could control. And at the point when I started retiring, I went to a seminar and one of Don's people were there and they gave a talk and I met Don through them. And he does have properties in Pennsylvania because I sold him some of my properties. So they are there. And that's how we became together. And I reinvested, just like he said, I reinvested the money in that rather than putting it in a bank. And it's worked out really good. It's like a third pension.
Awesome. So which investments are you in with us?
We're in with the fixed, and we're letting that compound, and the other one, we're taking the dividends. So you can break it up. You could either let it compound and grow, or you could take the dividends as just like a pension.
Yep, so he's in one of our funds that's very similar to the income and growth fund, a lending fund you're going to hear about, called the fixed fund, which is pretty much the same fund. And he lets his distributions, he has a fixed note, getting a fixed return, lets it grow. And then his other fund he's in is called the income and growth fund. He takes the distributions, supplement income each month.
And the checks do come in. Matter of fact, we got the one check, and 2 weeks later, we got another check. And my wife said, well, something's wrong here. So she called the office, and they explained it that you guarantee so much, but if that goes over, they wait till I guess your books catch up, and it cuts the second check, which was nice. We didn't expect it, and here you got a second check from it.
Awesome. Last question I have for you is, somebody here looking to invest with you, you've been with us for 6 years now, so somebody looking to invest with us today, what would you tell them?
Do it.
Pretty simple.
I can't see losing. I've studied real estate for like 30 years. He is timing the market just the way I would, and it's working out. And every time he says what he's going to do, he does it. And from my experience after 30 years, I agree with him. So I feel very secure. In the beginning, it's too good to be true. But as you started seeing what he's doing, you feel very secure with it.
Awesome. Thank you, bud. Round of applause. All right, so I told you at the onset we have two strategies we run here. I'm going to walk you through them somewhat quickly and then open it up to questions here. So the first strategy we run is private lending to real estate investors. So we're lending to other investors similar to ourselves or similar to Bud throughout his career, active real estate investors. A little overview of this strategy. We've been running this strategy now for actually this is going on year 5. We've generated over a 13% annual return net to investors. Our target has been 11%. As Bud said, we actually pay out a monthly distribution every month for the preferred return, which I'll talk about in a moment, of 10%. And then we send out a second distribution for everything we earned above that preferred return. So if you're taking distributions, you actually get 2 distributions a month in one of our funds, or the other one you get a distribution every month and you get a 4th distribution at the end of each quarter. One of the great things about this fund, and also can help if you're hesitant jumping into a new investment strategy, building a new relationship, is it's very liquid. So compared to any real estate investment fund, where you can redeem your investment with just 90-day notice. So you don't have to make any long-term commitments in this strategy. It's got great liquidity to it. It's a great way. A lot of talk has been, and it's dying down as interest rates don't appear they're going to keep rising, but over the past year there's been a lot of talk about interest rates going up. This is a great hedge against rising interest rates because we're lending money, and if rates go up, our rates go up. And then we have limited risk in the underlying real estate because we lend at very low loan to value, which I'll explain. So we have over 300 loans, which gives great diversification. We have 45 of our professionals in our company who run this strategy. We've done over 1,000 loans. If you invest in this strategy, on average, we deploy your money within 8 days. So one of the common issues we hear when you invest with a private investment manager is it takes a while to get your money invested, where you're not earning any money for a while. On average, it takes us 8 days. We start paying out distributions from day 1. So what do? We make short-term loans, 6 to 12-month loans, mainly 6-month loans to real estate investors who are buying single-family homes and apartment communities. So we lend on average single-family homes throughout suburban USA and apartment communities similar to what we buy. On the single-family side, on average, we're making loans for about $185,000. Our average interest rate is 12.2%. Typically, these are 6-month loans. On average, we're lending 73% loan to cost, which I'll explain, and 54% loan to value. On the multifamily side, lending against apartment communities, our loans are a little bit bigger because these are apartment communities with 50 or 100 apartments. But our loan to cost and loan to value are very similar. 71% loan to cost, 55% loan to value. So our value proposition, you might be thinking, people when they first hear it, they say, why would somebody pay 12% interest rate or 11% interest rate or 10% interest rate? Part of our value proposition here, a big part of our value proposition are the 3 E's of execution or surety of close. When borrowers work with us, they know we're going to close, they know we're going to come up with the money. 2 is experience. Working with a lender is not a lot of fun. No matter who you are, no matter what your financial wherewithal is, it's not a lot of fun working with a bank. We try to make it as easy as possible working with us. And then 3rd is expedience or speed. Typically when somebody's buying a property, a distressed property, they need to close in 15, 20 days. So they need a lender who can move very fast, which we're able to do. And then we provide them a lot of resources. Because we're an active investor investing just like they are, we have lots of relationships with contractors and vendors and knowledge and training and tools that we provide to them to help them grow their business. So how we mitigate risk in this strategy is all about mitigating risk. First is we're lending to strong investors. Our average borrower has nearly a 700 credit score. Our average borrower has a net worth of about $3 million. Our average borrower has about 500 grand of liquidity. And our average borrower has done about 25 real estate investments. So this isn't a guy who watched HGTV late at night and said he wants to buy a house. It looks so easy on that TV show. Everybody makes at least 50 grand, right? These are people who are doing this full-time, running a business with a staff, and really know what they're doing, often with a construction background as well. And all of our borrowers sign personal guarantees as well. So this joke here, if you can't read it, it says, if it would be so easy to flip this house. Get it? So that's what a lot of people seriously think, is it's really easy. Make it look so easy on TV. And we find most first-time flippers only ever do one. 80% of plus people do it once. They lose money. It's a lot harder than they make it look on TV. So we lend to people who've done this, who know what they're doing, and have it down. The next big way we mitigate risk, and in my opinion, the biggest way we mitigate risk, is loan to value and loan to cost. So I'll start with loan to value. So, and some of you have heard me say this before in previous dinners, but it's worth repeating here. So in the last downturn, and when most people think about lending, you think about the mortgage meltdown of 2008, right? The risk of your homes foreclosing. So in 2008, through the downturn, there were somewhere around 10 million homes that foreclosed in America. Now, most of those were to homeowners. We're not lending to homeowners. We're lending to real estate investors. But nonetheless, about 10 million homes were foreclosed on. Take a guess out of those 10 million homes, and existing investors, don't spill it here. Out of those 10 million homes, how many put down 20%? I heard none. Any guesses? What percent? 5%? Less than 0.1%. Less than 10,000 of those 10 million plus foreclosures put down 20%. A very, very, very small percentage. So if you were a lender and you were lending money to people and you knew that fact, wouldn't you think skin in the game, money down would be pretty important? Right? It's not complicated, but it's something that lenders constantly struggle with. The average loan today to a homeowner, take a guess at what the loan to value is today. How much? Let me make it easier. What's the average somebody puts down today on buying their first home? 20% I heard. 3%. 10%. So 3.5%. But you can then roll all your closing costs into the mortgage and actually get 102% financing. That's the most common source of financing today, not back in 2007, today. And that's been the case for a long, long time. So our average borrower puts 27% down out of both the purchase money and the money to renovate the house. And on average, we're at 54% loan to value. That difference of loan to value and loan to cost, that 19% difference, is the value they're creating. They're not buying it unless they're paying less than it's worth in general. So that's why loan to value is lower. But the bigger factor is loan to cost. They have skin in the game. They're not going to walk away from, on our average single family home, the borrower puts down $70,000 at closing. They're not going to walk away from $70,000. Another way we mitigate risk is our loans are very short term. So people often say, well, Don, it's 2019, the real estate market's going to go down at some point soon. Aren't you worried about that? Well, our average loan pays off in under 9 months. A third of our entire loan tape pays off every quarter. So we're not locked into long-term risk of property values dropping and our collateral declining and our loan to value going up, because our loans are very short term with a lot of equity in them. That liquidity as well, the fact that a third of our loans will pay off in the next 90 days allows us to give you great liquidity, because that allows us to honor investors being able to exit out of the fund very quickly. Another way to mitigate risk is you're not going and investing in one loan to one borrower, where all your risk is in that one property, that one borrower, that one market. We have over 300 loans across 80 markets, across 20 states, to 50 different companies, 50 different investors. And this shows by state a little chart of where they're located. We are heavy in Pennsylvania, Florida, and New Jersey because that's where we're located. We have a lot of relationships, and we know the markets really, really well. Most of our loans are 6 months. That dark blue, 88%, that's 88% of our loans are only 6-month loans. And then 56% are against single-family homes, 4% against 2 to 4 unit, 23% against multifamily, and then 16% is we're making one loan across many single-family homes. So it's still single-family homes, but one loan across many properties. Another way we mitigate risk is through underwriting. So we don't just take the borrower's word for what the property's worth. We go out there and we get a third-party appraisal done. We get an appraisal agent to come out and inspect the property every time. We get a construction inspection agency to go out and inspect the property, take pictures, evaluate the work. We do our own internal evaluation to the work, and we have our in-house construction team evaluate the scope as well. And then we hold back all the money they need to renovate the house, and we only release it after they complete the work. So we release it over a draw schedule, and we go out and inspect the property every time they need money as well. Another way we mitigate risk is through us, through DLP. The fact that we're a vertically integrated operator and we did have to take a loan back, or there was a problem with a borrower, we could. We've purchased a lot of homes, a lot of apartments. We manage over 9,000 apartments and homes. We have the ability to step in and finish a construction project, take over a property. We do it every day. This is a sample loan. So this is a home in Calhoun, Georgia, 4 bedrooms, 3 bathrooms, 2,300 square foot ranch. This is the condition inside, dated house, kind of what you'd expect looking at it from the outside. So this borrower had flipped 4 homes in the past 4 years, had flipped 5 homes. They had 4 years experience, had a 740 credit score. We did a loan for $105,000. This is the max loan to value we do, 70% loan to value, that's our max. 80% loan to cost, interest rate of 12.49%. And this is what it looked like at the end. I know some of you in the back won't be able to see that well, but they did a full renovation of this house, and they sold it for, I guess I'm missing that slide, but they sold it for more than actually the $130,000 appraised value, which is typical for us. Many of our borrowers sell the properties for more than we valued them at. So all this translates into the returns to you as investors. This is going to be impossible for you to read from the back, but the important thing you're going to see is the light green is the 11% targeted return we've had. The dark green is how much we've exceeded that return by every month or quarter. We've averaged a 14% return net to investors. Over the past 2 years, it's been high 12s, low 13s. Very, very consistent. The structure of this fund, it's a mortgage pool fund. It's evergreen, meaning the fund will be open indefinitely as long as it makes sense for us to run it. But you can redeem your investment out with just 90-day notice at any time. We have a 10% preferred return, which means you earn 10% before us. We don't even earn our management fee until you get a 10% preferred return. The target is 11, and we deploy your money an average of 8 days. You can take distributions from month 1, or as Bud said, you can let it reinvest and compound, change it any time, or do a combination of both. Or the other way you can invest in this strategy is as a fixed note holder. This is how a lot of investors get started with us. You can come and might not be able to read this in the back, but you choose how much you're going to invest, and then you can commit for 90 days, 3 years, or 5 years. And based on how long you choose and how much you invest, you'll get a fixed return on your money of 6 to 9%. That's a fixed guaranteed return by us, not guaranteed by the FDIC, guaranteed by us, and we pay you monthly distributions, or you can let it compound and grow. And this shows you what the returns would be if you let it compound and grow, because it compounds on a monthly basis. All right, and then you can invest in any of our strategies via an IRA or an old 401k, and says it's not all bad. I've crunched the numbers and figured out you can retire when you're 238. So a lot of people invest IRA money for the growth that it provides, consistent growth, which is really important in retirement accounts, of course. All right, so that's the first strategy. I'm going to go through the next one somewhat quick and answer questions. Second strategy is multifamily investing. So who likes giving Uncle Sam a third of their income? Anybody? So if you're looking to mitigate your income from tax, this is a great strategy for you. We're investing directly in real estate, so you get the benefit, the tax shelter of depreciation. So what we're doing is we're buying apartment communities just like you see in that picture, 200 to 500 unit apartment communities, we call Class B, mainly throughout the South, as you saw a moment ago. These are some of the pictures of the communities we own. They're also in those brochures that many of you have. We own, again, over 9,000 apartments right now across 50 different communities, mainly throughout the Southeast. Again, here's the little map of where they're located. So how we mitigate risk in this strategy is in-house management. So we manage the vast majority of our portfolio in-house. We employ 150 people who manage our properties every day: construction, maintenance, property management, asset management, etc. These are some of the leaders who manage the properties. Next way we mitigate risk is simple but hard. It's disciplined buying. I'm a big believer that you make money when you buy something, not when you sell it. So we really focus on buying properties at less than they're worth now. It's a hard thing to do in a market like today, but we're very disciplined in our buying. We create value at the purchase in addition to how we manage the property. Another way we mitigate risk, and this answers the interest rate question that people often ask, is when we buy a property, we typically lock in long-term debt, meaning our interest rate is fixed for 10 to 12 years, meaning the interest rate can't go up, even if the rates go up in the market, and our debt is non-recourse, meaning nobody's personally liable for the debt. How we find these great deals is we underwrite, and some of our analysts, one of our analysts is right here, and the rest are in the room somewhere here, and you can talk with them about this, but they analyze hundreds of deals every month. We go through tons of due diligence and evaluation on site, evaluating the property, walking the apartments, going to the police station, looking at the competitive properties, evaluating the demographics, doing financial analysis, you name it. Out of those hundreds of properties we look at every month, we buy about one a month. When we buy that one property, we buy it at the right price. Then we go in there and we add value. Typically, unfortunately, because it's a lot of work, but it's where we create value, we have to do a lot of work when we buy these properties. So typically we're coming in here into properties like this. This is actually a pretty nice community. You can kind of see a boarded up room. The pools were down, units were dated, and we come in there and renovate the kitchens and the bathroom and hard surface floors and clean up the exterior of the properties. We're often doing $10,000, $15,000, $20,000 in renovation per apartment. Here's a property in Pennsylvania, in Nazareth, where Bud's from, that we bought. That was a smaller property, but it was really rough shape. It was basically a rooming house. And we turned it into 16 beautiful brand new apartments, redid the whole outside. Here's one that's called a Cardinal community. We own 10 communities that look just like this. They're all exactly the same. We own about 1,500 apartments that look just like those. And when they come in, they look like that. And we turn them into that, hard surface floors and nice kitchens and fresh and clean and safe apartments for $700 a month. Again, more pictures. This is a property in Brunswick, Georgia. It had 40 apartments that were like this for 10 years when we bought it. They hadn't been touched in 10 years, never rented, just sitting there like this. And we came in there and renovated all 40 of them just like that, each one renting for about $1,000 a month. So why do we invest in multifamily? Well, this probably isn't a surprise to a lot of you. Rentership is on the rise. It continues to rise. Less people are owning, more people are renting. Family formation is happening later in life. People are having kids later in life, so people are staying renters longer. Plus, people are more transient than ever. They don't stay as jobs as long, they don't stay in location as long, so they want the flexibility of rent. We invest here in the Southeast due to strong demand, largely because of strong job growth, and because people, when they retire as well, like to move to warm weather. Who here has moved from the cold to Florida? Almost everybody. So that's why we invest in the Southeast, because people are moving there, and that's where jobs are going. Florida, Georgia, Carolinas, they're very pro-business states, a lot of job growth. Which means lots of demand. We invest mainly in secondary and tertiary markets, meaning we're not in many markets like Atlanta or Miami. We're in smaller markets because there's less competition, we can get stronger returns, and we get more diversification. We invest mainly in B-class apartments, which mean they're not luxury apartments. Properties built in the 1980s, 1970s, 1990s that aren't brand new, where our average rent's $800 a month versus the brand new apartments being built in Jacksonville that are $1,700 a month. So we invest in the types of properties that people can afford. So in the past 10 years, and again, existing investors who know this answer, don't say it, take a guess in the last 10 years, how much rent has gone up as a national average? Double? Any other guesses? How much has rent gone up just in the last 10 years? Since 2008, how much have rents gone up? 15%? So about 55%. It's not quite double, but 55%. Whereas how much the average U.S. rent has gone up in the past 10 years. In those same 10 years, taking the bottom 75% of wage earners, so most of Americans, take a guess at how much income has gone up. About 4 to 5%. So rent went up 55% and income went up 4 to 5%. Anybody see a problem there? Right? And not to mention, they don't build affordable apartments anymore. You can't afford to. So there's no new product, yet more and more demand for affordable places to live all across the country. Our average apartment that we rent today for $800 was $500 to $550 in 2008. Apartment that was $1,000 is now $1,500, $1,600. So one of the great reasons that we're in Class B, there's been almost zero Class B apartments built in the past 10 years. Nearly zero. You can't afford to build it. Everything that's built is luxury. So we think that puts us in a great position that when a market correction comes, it's actually going to create more demand for affordable housing, not less. And since there's no new supply, it puts us in a great position. Here's an example of a community we bought in Valdosta, Georgia, not too far from here, a little over 2 hours away, 300 apartments. This is what the community looks like. We bought this property. The average rent was, is it on this slide? No. About $523 a month. We'll increase the rent to about $700 a month. And we bought this property at $37,000 per apartment. It'll be worth here within a few months about $55,000, $60,000 an apartment at least. And we've come in there, renovated the outside, cleaned it all up, renovating about 60 apartments right now, driving up the value. This is kind of what the community looks like right now. All right, so how do you invest in this fund? The DLP Preferred Return Equity Fund. So in this fund, it's a little different than the other fund. In this fund, you're going to commit for 5 to 7 years. But if you do need to get out, if life happens, good or bad, you need to get out, you can redeem with a 180-day notice. But you go into this fund looking for a longer-term investment, a way to mitigate tax and earn in a tax-sheltered way throughout your investment. The goal is to generate an 8 to a 9% return on an annual return, paid out quarterly. So basically, return about 2% a quarter. We just finished up our Q4 report, so anybody in Preferred Return Equity Fund, we ended up a little over 8% net to investors. One of our first quarters. This fund just opened here in the second half of last year. It already owns over 1,500 apartments. And then the overall return goal is at least a 12% overall annual return. So distribute to you 8-9% a year, paid quarterly, and at the end of the fund, return back to you 1.5 to 2 times your original investment, depending on how long the fund goes. And when you get that money back at the end, you're going to get that money back at long-term capital gains versus paying ordinary income. So very tax advantageous. Same thing as the other funds. You can reinvest, take distributions. In this fund, it's every quarter. And you invest directly in this strategy of owning apartment communities. This fund will end up owning 3,000 to 4,000 apartments throughout many of those markets I talked about earlier. So now you're thinking, wow. So how do I take advantage? So we do not sign anybody up here tonight, although we did actually have some investors bring some checks here tonight, but we don't sign up people here tonight. That's not the goal tonight. It's to give you information, get to learn. Then you can sit down with Larry or Mike or any of our team and talk further and explore what can make sense for you, if anything. And you can also go to DLP Crowd, where you can see all of our past financials, audits, reports, our actual assets we own, etc. And last couple items here before I open up to questions. You can register for upcoming events at dlpcapitalevent.com. I'm going to talk to you about an upcoming event here in a second, which is the DLP Inner Circle event. So this is actually next weekend, believe it or not. Some of you I know are joining us. This is our second event we've done here, and this is a weekend event. It's called the DLP Inner Circle. So what the Inner Circle is, it's our closest group of investors. We have about 60 Inner Circle investors across DLP. The qualifications to be an Inner Circle investor is you have $1 million invested with DLP, or you referred 3 investors to us. one or the other. If you don't yet meet one of those criterias, still talk with us. We have about 3 rooms left. So we own an oceanfront hotel in St. Simon's Island. We have the whole hotel reserved, plus the hotel next door reserved for us. We have about 44, I believe, of our guests coming, of our investors coming to this event for a great weekend, fun times, golfing, bike tours, exploring, really cool, which many of you have probably been to St. Simon's Island. A number of people in the room were here with us back in May. And so we have a couple rooms left. We want to make sure we certainly fill them all up. So if anybody's interested, talk to Larry or myself. I will try to play this quick video and see if it works, which is a quick minute video on from the event we just did in May. Let's see if it works. Like still, there we go. Look at this. Well, hopefully you got the gist of it. So it was a really, really great time, and that's why we're going back there again for our second event. So if you'd like to join us, reach out to us as we want to fill up these last couple of seats at the event. It'll be a great time. All right, so last item we're going to do here is the raffles Larry mentioned. And while we go around and collect, I'm going to open it up to questions. But fill those forms out if you haven't already. We're going to give away two raffles here, one for existing investors, one for prospective. And what we're going to give you is a weekend in St. Simon's Island. And you don't even have to bring us with you. This weekend you can go all by yourself and have a great time at an oceanfront hotel. It's an amazing, amazing place. So fill those out. And while you do that, I'm going to go ahead and answer questions. So just ask you to raise your hand. If you think you talk loud enough that you can just shout it out, feel free. Otherwise, I'll walk over to you with the mic. So floor's open. Pass this over there for me.
Don, I'm sure many of the folks that are here maybe for the first time or so are curious about the investment management fees from the company. I know you haven't answered that.
I think he was setting me up there for a good answer, so I appreciate that. So his question was about investment fees. And it's a good question that I frankly don't do a very good job of probably explaining. Everything that I showed you tonight is net of fees. So when we say we generate 11% plus returns and 6 to 9% fixed returns, that's net to you. There's never a dollar that comes out of those returns. Everything we display, everything you see in the brochures, everything we talk about is net of all fees to DLP, not $1. If you had to pay to wire your money to us, we'll reimburse your wire fee. I mean, there's no expenses out of those returns. So thank you.
With your multifamilies, do you hold on to those assets for long term, or do you sell them after 5 or 7 years?
Yeah, great question. Something I should talk about too. So typically our funds are designed, and when we buy a property, it's designed to own the property for 5 to 7 years. That's why the fund is a 5 to 7 year fund. Right now, this year, 2019, out of our 9,000 or so apartments we own, we will sell over 3,000 of them this year. And some of those we've only owned for 1 or 2 years, but we know that it's such an amazing time this year to sell. The market's so hot still. There's so much money still trying to go after multifamily. So basically what all the big smart people in Wall Street have realized is B-class and C-class multifamily is a really safe place to invest when the market's going to turn. And everybody's looking for a good place to put your money. So billions and billions of dollars have been raised to go into B and C class multifamily this year. The stat I heard is 36% of all money raised for real estate is for B and C class multifamily. So there's so much money chasing multifamily right now that we realize it's a phenomenal time to sell. And we do think the market will soften at some point in 2020 or 21. So we kind of looked at it and said, if we don't want to have to own the property for the next 5 to 7 years, let's reap the rewards today. And part of that reason as well is we want to get a lot more liquid. Myself personally, I own 42 to 44% of our real estate portfolio personally. So I wanted to get more liquid, mainly for the reason of being able to capitalize on the opportunities that are going to come as the market goes down. So we're going to capitalize, take money off the table, get more liquid. I'm going to put that money into our own lending strategies personally, but we're still going to keep buying because we're still finding great opportunities. Opportunities are changing a little, but we're going to capitalize on selling a lot of property. So in general, we underwrite to own for 5 to 7 years, but we may sell sooner if it makes sense to do so. So great question. Jen, is your hand actually up? Oh.
So the first one's about the foundation, and the second one, it's just so close. The second one is when you buy apartment buildings that have residents already in them, what happens to those residents while you're renovating them?
Yeah, great question. So I'll tackle the second one first. So she asked, we buy a property that has residents, what do we do? Well, first, a lot of times, unfortunately, when we buy a property, one of the reasons we're getting a great deal is because a lot of the tenants aren't paying their rent. And the previous owner didn't do a very good job of screening, of putting good residents in there. And sometimes the residents aren't the problem, it was they weren't managed well. Tenants can be a great tenant if you help them manage their money well. But as soon as they get a month or two behind, they're not coming back out of it. Is typically how it is. Or if you have management that kind of ends up waiving rent, they kind of get used to that and expect it. So we do end up with a good amount of turnover in the beginning of moving out. People aren't paying rent and sometimes moving out bad elements. Moving out issues such as drugs or violence out of communities. That's all through America. It's out there, and you're going to find that in every apartment community. So we've spent a lot of time when we see those signs of those things, moving those people out. So we do deal with moving out a lot of challenging people and situations in the beginning. But then the good tenants that we have that are paying their rent, they love us. And we do everything we can to keep them. Very often we end up coming in situations where you get somebody who's been living in, and it happens to be, tends to happen to be, an older lady who's been living in her apartment for 16 years, and it's been neglected, and it's really run down, and the previous management company didn't do anything because she was paying her rent. And then we'll come in, and we literally had a great story on this a few weeks ago where we renovated a brand new apartment. This was in Columbus, Georgia, and we helped move the lady. My guys spent the weekend moving her into this brand new apartment, and then we went back and re-renovated the old one so she could be in a new one and didn't have to leave the neighborhood. And it was a really cool story. So we do that type of thing quite often. So we try to keep great people. We work with them. We'll take lower rents. We do try to get them up. It's closer to market rent. But we work with them to keep good tenants who pay their rent and like where they live and are respectful, and move out the ones who aren't. And so it's a big part of the value we create in the first year of owning the property. Second question Jen asked, and she's done this a couple times, and I guess I should learn that she's going to do this and put it back in the presentation. But her question is about our foundation. So we have a foundation called the DLP Positive Returns Foundation. And we're launching a new fund here any day, Barry, hopefully any day. We're waiting on the SEC. But a new fund that's called the DLP Positive Returns Fund. In that fund, it's a way to invest. It's just fixed returns, 6 to 9% fixed returns in really low leverage, institutional quality lending. Very, very low leverage, just like the notes we have now. But it's a note-only fund. And that fund is called the DLP Positive Returns Fund, and our foundation is called the DLP Positive Returns Foundation. And the 1% management fee we earn for managing that fund, we're going to donate 1% into the foundation on behalf of every dollar we raise. So we've been kind of waiting to talk about it until that finally gets live, because our goal is to put $100 million in that fund and in turn donate $1 million to our foundation through that. But then we put money into the foundation for lots of other reasons as well. We haven't really done outside capital raising or anything yet, but we've been donating to the foundation. And we have 2 causes that we focus on. And they're very similar to the 2 causes that we operate in as a for-profit business. So I believe there's 2 big epidemics in America. One is the job epidemic, that jobs are being deleted at an alarming pace. It's not because they're going to Mexico. It's because they're being lost to technology. That's the main cause. They estimate Amazon alone is deleting over 1 million jobs a year. There's 3 million cashiers in America today. How many cashiers do you think we're going to have in 5 years? Right? I mean, most places are getting rid of cashiers, as an example. So there's not jobs for most of these people to reposition into. They have to be created, and I believe the only way jobs are going to be created is through entrepreneurship. So it's us focusing on creating jobs through inspiring and helping assist in developing companies and entrepreneurship, which is really largely what we do in our lending business with our borrowers. And then the other epidemic is that of affordable housing. As I talked about earlier, rents keep going up, cost of living keeps going up, but incomes are not. And new housing is not being built to handle where the incomes are. And that issue is compounding, constantly. So that's a big focus for us. In a lot of different ways we plan to help there. Right now we're working with a group called Good Works. And what they do, and they're a Pennsylvania-based organization that's expanding, and what they do, they're a faith-based organization. What they do is they go into somebody who's been living in their home for a while, and the home's in disrepair, and they provide them both, faith-based counseling, but then they come in and provide on average $10,000 worth of materials and $20,000 worth of labor for free, and help renovate these homes. And they come into situations with kids living in homes with mold and CO emissions and all kinds of really unsafe environments. And they renovate these homes and try to help the people, because usually there's something going on with them that's caused them to let their home get in this condition, so they can stay in their home versus having to move out of it. And for years we've been doing things like paying for renovations for people so they could sell their home and get more money and things like that. So those are our two big focuses of our foundation. So thank you, Jen. Rudy?
Don't want to get too much in the weeds, but okay, as a corporation having to pay taxes as the rest of us do, and you sell a property, you're subject to capital gains unless you 1031 it. So I'm a little bit intrigued as to whether you 1031 out of one property into another property, and when you actually do liquidate a particular property after you brought it up to full potential, I guess you're weighing the factor of what the increased rents are versus taking that money. And once you take that money from your sale, I assume you're going to reinvest that into another property, which will give you an opportunity up front.
Sure. Thank you, Rudy. So his first question was about 1031 exchanges. So a 1031 exchange is when you sell one piece of real estate and you buy another one. And by buying another property, you delay tax. You don't have to pay tax when you sell the property because you're reinvesting in what they call a like-kind exchange. So yes, we do 1031s for ourselves when we sell properties. And we also have lots of investors who sold their properties and then in turn did a 1031 exchange with us and then were able to defer out tax. And that's how a lot of investors have invested with us. Went from being an active investor to passive and not having to deal with the tax consequences of that. So yes, we do that. We have a very unique, we call preferred or pref 1031 exchange, where we actually pay you a fixed return and you avoid tax. It's a really, really unique way to invest. And then to your question on doing 1031 exchanges, we are actively doing them. A lot of these properties we will sell. We will go into 1031 exchanges. And we always try to create ways to help our investors mitigate tax. So our first equity fund, our first fund that bought real estate was called the Equity Fund 1. That fund is winding down right now. And we're going to end up with about a 20.2% annual return net to investors. And so we were able to come to our investors, and I give Bob all the credit on this, our CFO. We did not give any expectation that we'd be able to do this, but we were able to work out a way to be able to give investors the option of either taking their distributions and paying tax, if they're not already in qualified or IRA accounts, or being able to roll their money into another partnership and defer out tax. So about half of those investors are going to defer out the tax for the next 5 to 7 years and not pay tax and continue to get great returns. And about half are going to pay the tax, but many of those are in qualified accounts. Or like some of you maybe, some of our investors have large losses on that they carry forward, so it's not actually affecting them. So there's a lot of details when you get into personal tax. But yes, we really work hard to help you in mitigating tax, and real estate's a great way to do that. So thank you, Rudy.
She couldn't go in there.
Rudy always brings me because I ask lots of questions. But I came to sing your praises. One of the best things we could have done is we had an IRA, and we usually were nickel and dime this debt. $5 to pay taxes on this, or $5 to pay this and that. We moved the money over to you and we're making good money, so thank you.
Awesome.
That's all I said.
Thank you. Thank you. Thank you, Trish. Oh, no. Anthony's our head of investments, and he likes to give me a hard time, so we'll see.
Don, why don't you maybe perhaps explain how an investor is protected in your deal structure on pref equity?
Yeah, it's a question I skipped over, or a topic I skipped over. So the current equity fund that we manage is called the Preferred Return Equity Fund, which stands for, we call it PREF Fund for short. What preferred return equity means, or at least what it means here, is that every deal we buy, every piece of property we buy, there's two types of equity that goes into that investment. Preferred equity, and we call common equity. You invest as preferred equity. What that means is if we bought a property for $5 million and we put $2 million of equity into that property, some of that money will come from the fund in a preferred position. Some of that money will come from myself or from our other operators that we work with in what's called common equity. And here's the short of how it works. Is the preferred return equity investors get to take all of the cash flow, all of the income, before we earn anything. So our preferred investors get a 9% return before the common equity gets any return from the cash flow. Then when we sell the property, our preferred investors get a 12% annualized return on their investment and all of their money back before the common equity even gets their money returned. So common equity could lose all their money and the preferred return investors could get an 11 or 12% return. So it's how we go about protecting our investors, and that's our mindset, as we said at the beginning of our rules of investing, is no losses to investors ever. So it's not only in the types of investing we do and how we mitigate risk in the investment, but it's also with how we structure our investors with us. Just like in our funds, we pay our preferred returns before we even earn a management fee, which I don't know any other fund managers who do that, because we put our investors first, because we think it's our job to mitigate the risk and put your interest first. So, thank you. Any other questions? I know we're anxious for these raffles here. All right, well, let's go ahead and get the raffles going. Feel free to grab another drink as well as we do so. Larry, do you have them? All right. So, what's white? Existing investors. So I need a prospective investor to pick the name here. All right. So the winner is Nolan. Congrats. So we'll come over to you then. But congrats, sir. So you win a weekend vacation. Awesome. All right. So I will give you that. All right. Now this is for existing prospective investors. So I'm going to get an existing investor to pick the name here. So Barry, why don't you do us the honors? And the prospective investor is Pat Cotton. Congrats, Pat. So Larry will come over and talk to you about it then. Congrats. All right, everybody, so that's everything we have. Feel free to grab another drink. I'll be around to answer questions as the rest of our team will. And thank you for all your time here tonight.